very much for your time. My intent is not to disappoint you, but let me be very frank in saying one thing. This presentation is not to help somebody how to make an investment or how quickly you can become rich or help you decide what is good, what is bad. But the objective of this is learn few lessons from somebody else's success or failure. To succeed in life, not only in investing, generally in life, it's not that every lesson we need to learn ourselves. We can also learn lessons from others' experience. This is a common subject. தமிழில் சொன்னோம்னா கோழியிலேருந்து முட்டை வந்ததா முட்டையிலேருந்து கோழி வந்ததான்ற மாதிரி. Is investing a science or an art? Many people will say it's a science. So does it mean investing is purely a science? If that is the case, people, great mathematicians or great practitioners of science should have succeeded tremendously in market. And this is a market which is notorious for many Nobel Prize winners going under. That doesn't mean that investing is not a science. Is it an art? If you refer Oxford Dictionary, art keywords are aesthetic, appeal, beautiful. Our point is, investing is a combination of science and art. What combination, what proportion differs from people to people, but it is certainly a combination. So the reason why I'm stating that is the science part deals more with the EPS side of the equation. Art part deals more with the PE. What it means is, even if you are great in science point of view and identify companies which have excellent EPS prospects in the next 3-5 years, your stock price might still decline if the PE that you entered was wrong. Right? Classic example, between 2002 and 2007, had you bought Hindustan Lever in 2002 and sold it in 2007, during which period index went from 3,000 to 15,000, you would have been lucky if you had got back your capital. This is Hindustan Lever. Why? The entry PE would have been 40, but 2007 PE was 14. So, it's not science. But if you get into a company where you have no clue about the EPS and say that this PE is low and it is going to expand, you are a speculator. Right? So, you can still survive without art if you have longer time period. But you can't survive in investing. Your investing experience may not be good if the first side of the equation is wrong. If you're buying a stock, the first thing we have to tell ourselves is we are not buying some piece of paper, we are not buying some price, all we are buying is part ownership of the business. This is something which we all know. In Tamil, aridalnu onnu irukku, உணர்ந்துங்கிறது ஒன்று இருக்கு. அறிந்து செய்யறதுங்கிறது we all know, we are aware of it, that is அறிந்து. உணர்தல்ங்கிறது we felt that feeling, and this is where some of the return numbers professional fund managers like us tell you or show you might not be the actual experience an investor would have felt, because during the journey the temperament drives an investor to get in, get out. In subsequent slides, we will be seeing investor experience, how it differs from investment experience. Let's say a mutual fund that says that my NAV is up 10 rupees to 50 rupees. That doesn't mean that every investor, every holder in that fund would have made money, right? During this journey, the 10 rupees would have become 80, then fell to 40, then now trading at 50. Many of us would have got out, not when it was 80. After the drop to 40. These are some of these numbers which I am sharing to say that over a long period of time, the return that you will make in a stock is nothing but the earnings of the underlying company. Show me one company where the shareholder return diverged from underlying company earnings over a long period of time. The return a shareholder earns from a share is nothing but the net profit of the company. Let's say you are an entrepreneur, you own a business. பக்கத்தில் ஒரு டெக்ஸ்டைல் ஷாப் வச்சுருக்கோம், ஹோட்டல் நடக்கிறோம். ஒரு அசம்ஷன் பண்ணிக்கோங்க, உங்ககிட்ட வேறு எந்த சொத்தும் இல்லை, அந்த ஒரு பிஸ்னஸ் மட்டும் தான் இருக்குது. அந்த பிஸ்னஸோட 100% ஸ்டேக்கும் உங்களுது. உங்களோட வருமானம் போன 5 வருஷம் எவ்வளோங்க அப்படின்னா ஈஸியாக கண்டுபிடிச்சிடலாம். என்ன வருமானம் ஆஃப் தி கம்பெனி இஸ் வருமானம் ஆஃப் தி ஓனர். So why should it differ differently for a 1% holder or a 0.1% holder than a 100% holder? It should not. And it doesn't. Which means, if you tell me that the next 20 years return on ITC is going to make from its business is going to be 20% per annum, I can be 101% sure that your return, if you hold it for the same 20 years, will be the same 20% per annum. But it doesn't hold good every day, or every month, or every year. There can be extended periods of time where a stock price diverges from the earnings, both in positive direction as well as in negative direction. Which means in 2007, the earnings would have grown 20%, but stock price would have moved 80%. Between 2008 and 2012, the earnings would have moved 50%, stock may be at the same place. Or in between might have dropped 70-80%. This is a graph I whacked from our competitor, Motilal Oswal, thanks to them. What it gives you, there's no point in spending too much time, but the point I'm trying to drive is, how much you think market has given us a return in the last 20 years? 1990 2000 வரைக்கும் மார்க்கெட் 5 மடங்கு ஏறிச்சு. 100 ரூபாங்கிறது 500 ஆச்சு. 2000 2010 4 மடங்கு ஏறி 500 2000 ஆயிரம். 1980 1990 market almost 7 time ஏறி. So if 1977 78 100 has now become 19,000 or 20,000 or 80,000, the same thing if you express in percentage terms is about 15%, 15.5%. How much it is from 1992 till date? Same 15%. How much it is from 85 till date? Same 15%. Over the last 20 years, Sensex has grown at the rate of 15.5% per annum. So had you bought Sensex 20 years back and held, you would have made 15.5% per annum. The companies which were part of Sensex have also grown their earnings during this period at the same 15% per annum. But the pace of growth, for example, 1993 to 96, net profit of the companies went up 45% a year. Subsequent 6 years, net profit of the company grew 1% a year. Subsequent 6 years, 25% it grew. Next, the last 6 years, it has grown 7%. If I get into the discussion of why 7, why not 15, then the whole debate will be that. But my objective of showing this is only very, very simple, is over a long period of time, a shareholder return cannot be higher or lower than the profit growth of the companies that the shareholder is owning. As simple as that. If his return is higher than the profit the company is earning, it is what is called borrowed PE. Somebody is overpaying and he is getting that. If he is getting less than what the company is earning, probably he has overpaid it in the first place. 11th December 2007, the first day, Sensex closed higher than 20,000 in the history. 15th July 2013, we all know, is one of the recent days when index was 20,000. Both the days, index was at the same level. But during this period, ITC price போட்டிருக்கேன். அன்னை விலை 11 டிசம்பர் 2007, 15 ஜூலை பிரைஸும் போட்டிருக்கேன். ITC வந்து அன்னைக்கு வந்து 94, இன்னைக்கு 350, இன்னைக்கு 315, அது ஒரு விஷயம். 15 ஜூலைல 352. TCS இதெல்லாம் போனஸ் அட்ஜஸ்டட், ஸ்பிளிட் அட்ஜஸ்டட். TCS 500 ரூபாய் இருந்தது 1600, லீவர் 210 ரூபாய் இருந்தது 613. தி பெஸ்ட் பெர்ஃபார்மிங் ஸ்டாக் which has gone up 4 times. 1 லட்சம் ரூபாய்க்கு ITC அன்னைக்கு வாங்கியிருந்தோம்னா இன்னைக்கு 3,76,000. ஆனா 1 லட்சம் ரூபாய்க்கு சென்செக்ஸ் அன்னைக்கு வாங்கியிருந்தோம்னா இன்னைக்கும் அதே 1 லட்சம் ரூபாய் தான் இல்லைங்களா? TCS 1 லட்சம் ரூபாய் வாங்கியிருந்தோம்னா இன்னைக்கு 3 லட்சம். So you have one stock which went up 4 times, one which went up 3 times, two which went up 2 times, and almost 4 stocks which doubled, and you have another 5-6 stocks which went up more than 50%. But look at the bottom. DLF down 82%, Reliance Communication down 80%, Reliance Infra down 70%, Tata Steel down 70%. 1 லட்சம் ரூபாய்க்கு டாடா ஸ்டீல் வாங்கினா இன்னைக்கு 30,000 ரூபாய். BHEL 1 லட்சம் ரூபாய் வாங்கினோம்னா இன்னைக்கு 35,000 ரூபாய். So at macro level, market looks, to an outsider it looks like market is in range bound range, but it's a completely different world within the index. If you are a guy who is a shareholder of ITC, this is one of the best period. Last 4 years is one of the best time. ITC shareholder had never made 4 times in 5 years in the last 15 years, other than this block of 5 years. So it is, what is important, as he rightly pointed out, is the sectors that you are present in, stocks that you are present in. Instead of ITC, had you been in some other similar company, your experience may be slightly somewhat similar to that. But my question is this: okay, during this period the stocks behaved like this way, but during this period how the companies behaved? Let's look at the same thing between 2008, 9 and 2013. Look at the companies which performed. Top 5 shares in the previous graph and bottom 5 shares in the previous graph. So ITC earnings went up 127%, stock went up 300%. So you had a E expansion as well as PE expansion, which means shareholder return will be multiple times. Invariably, this is the curse of the market, this is the bone of the market. When things go well, it will go doubly well. When earnings grow, PE will grow. So if share price in the first slide we saw is equal to E multiplied by PE, as E keeps growing, PE will eventually grow, will come closer to the E, which means the benefit you will get is double. But will PE grow because of E growth, or will E grow because of PE? Can E grow because of PE? Can a profit of a company grow because market is expecting the company to do well and therefore PE is high? No way. So therefore, the science part of the equation is very, very critical. Which means if you think you don't have the skill set to understand the earnings expansion of a company, whatever other understanding you have is useless. So during these 5 years, when people say market has lost its sense, market doesn't trade rationally, we are seeing the top 5 best performers of the market are the top 5 companies which have done reasonably better, relatively better. Companies that do very well now may not do that well in future. Companies that struggled in the past might do well in future. But we all learn the lesson, we always fight the previous war. People used to say, what it means is 3 வருஷம் 4 வருஷம் கம்பெனி நல்லா வந்ததுக்கு அப்புறம் போய் அதை வாங்குறதுல பெரிய பிரயோஜனம் ஒன்றும் கிடையாது. Because we always extrapolate the recent phenomena. But mean reversion is something which happens time and again and again and again. Look at this. We discussed this, that lever between 2002 and 2007 didn't do well at all. And the ITC went up 159%, looks like a big number, but let's look at the numbers in the bottom two. Tisco went up 5 times. Reliance went up 8 times. I'm talking about 800%. over same 5-year period where lever didn't even move. So market is in a cycle. After seeing 8 times rise, if I go and buy Reliance, saying that see every year last 6 years consistently Reliance is doing well, and if I go and buy Reliance, my subsequent 5-year period return would have been minus 45%. How much the same RIL gave the subsequent 5 years? Minus 45. How much Tisco gave subsequent 5 years? Minus 65, 69. But am I therefore conveying to you that you should trade and you should jump off, you should do? All I am trying to say is, please do not extrapolate a recent phenomena as if it is permanent. If you have a strategy, you should be very stringently following that. But invariably, instead of getting into Reliance in 2002 and getting out in 2007 and get into lever in 2007 and get out in 2003 will look great in a hindsight, humanly impossible. And many of us who try to do that fail. And absolutely, absolutely. I can take one credit. I might not have earned more than 15, 16, 17% over the last 20 years, but I can take few credits. One credit I can take is, in 2010 when market recovered, we closed our best performing fund. What is it? Just close. Not many fund managers do that. Because what are you doing? You are closing the fund, putting the capital back to the investor. There's a different reason why we did it, but we felt completely uncomfortable with that. Okay, in this last 3 months, how many IPOs are you seeing? How many new issues you are seeing? We have launched 2. We have 2 IPOs for our target audience. What I am trying to say is, when blood is on the street, you can be bullish. I am the most greediest person today. We launched a fund with a target of 100% return. People are asking, capital preservation is predominant. People are not sure about preserving their capital. But this is a time to be greedy, which is what we are migrating to the next level of the discussion. How do you do contrarian investing? That doesn't mean, don't get into technically correct answer English wise, but technically wrong answer investing wise. Contrarian investing doesn't mean, let's do a poll here, and if 80% of you are bearish, let's go and buy, and if 81% of you are bullish, let's go and sell. Because it is correct, contrarian investing means that, but it doesn't mean you should do by a poll. Because the same poll, had you done 6 months back, mood would have been the same. 2010 would have been different. Maybe 1 year later, mood may be the same. A contrarian investor will undergo a lot of social stress. Actually, I am bullish. I am bullish in market. Over the next 3 years, we are very, very bullish, and we are buying. We are fully invested. 100% we have no cash left in our. The reason I can afford to be bullish, and I don't know whether I am right or wrong over the next 3-6 months, but I know eventually I am right over the next 3 years, is the fact that I have communicated to my clients the contrarian merit, and I have just 430 clients. It's easier to communicate to a less number. If I am a fund manager of a mutual fund and I have million investors, I cannot communicate. Right? So, I am bullish now. I was bullish 3 months back. I was bullish 6 months back. I've been bullish for the last 8 months. So during these 8 months, it was tougher to be bullish in a market which is hitting you on front, back, left, right, right? So, all I'm trying to highlight is contrarian investing eventually works very well, but it has to have, the guy who practices has to have some kind of temperament, which is what I highlighted, saying to have a good investing experience, it's not enough you just know what is good, what is bad. You also have to have a temperament and conviction to hold on till others see your point. That others sometimes might see your point in 3-6 months, sometimes they may not see it for 3-6 years. If you leverage and invest, you don't have the luxury of waiting. If you put all your eggs, all your wealth in equities, you don't have the luxury. This is where discipline comes. But even if you have put only 10-20% of your wealth and you are not leveraged, but you don't have the temperament to see negative returns, everybody has a tolerance level, right? We all have the so-called inflection point. 2-3 months is okay. 2-3 years of no return and negative return, is it okay to most of you? It happens. In equity, it happens. 1 lakh becoming 20 crores over a 30-40 year period is just a return of 19.6%. If 19.6% is what world considers as the best over a long period of time, because this is sustainable 19.6 year after year, every year. If you know how to earn 19% year after year, every year, then your 1 lakh can also become 20 crores. And one day you will also be rubbing your shoulder with Mr. Warren Buffett. I didn't rub my shoulder, I actually rubbed my hand. And I thought it's a great achievement. I took the autograph, which if you come to my office is still, framed in our research dealing room. But the point I'm trying to drive is be humble enough to accept the fact 19.6 is world's best year. And I can tell you, you may not like it. Please note down in a piece of paper and see it every day for the rest of your life. You are not going to make 19.6% per annum over the next 40 years, over the next 30 years. There are 2 points. One, in the previous graph, did all of us invest the same amount of money at all points of time in market? No. Did some of us come into the market during this 10 years period? Yes. Which means we didn't invest, not all of us invested all the time in market, and those few of us who invested all the time in market didn't invest the same amount of money in all market, which means more investors came in 2005, 6, 7, and the existing investors invested more money in 2005, 6, 7. Right? So, you didn't earn the full upside, or you didn't earn full upside for all the money. Many of you didn't even earn half the upside, but all of us felt the full of the pain. So I'm not again, that's what I said, I lifted my collar, 2006, 7, 8. We didn't raise any money. No new launches. We know this cannot go on. What cannot go on will eventually stop. Out of this 1,20,000 crores, 55,000 crores came in 2007. 37,000 crores came in 2006. Okay, how much came in 2009? If we all know buy low, sell high is all about investment, why don't we do it? In 2009, how much came? Negative. 2010, 2011, negative. 2012, 500 crores. 40 mutual funds, 293 schemes, 37,000 employees, 500 crores. How much was they collected last year, March 2013? Minus 14,000 crores. Left hand side graph, if you see, you know how much of damage investors are doing to themselves. So 2007 you bring, if you consider total money invested by all investors in India as 100 rupees, right? 47 rupees came at 24 PE. Prashant Jain, who is the fund manager, largest fund manager of India, right? He manages close to 40,000 crores. I manage probably 500 crores. It's big. He's number one. He says, it's shameful to me to admit, he said this in stage, full thanks, full credit to him. He said, market over a 20-30 year period gives you 15-16% return. And therefore, PE has to be closer to the E range. And therefore, 80% of the time, market PE is between 14 and 18. This graph revalidates that. If you extend this graph for another 10 years, another 20 years also, out of last 240 months, 186 months, market PE was between 14 and 18. Only 20% of the time market PE is below 14 or above 18. Below 14 is when there is panic, like today. Above 18 is when euphoria sets in. Now, this Prashant Jain, India's largest fund manager, says 80% of my money, that is 80% of the investors who invest in equities, invest when PE is higher than 18. Post 1991 Harshad Mehta scam, market has fallen below 14 PE only thrice. And if you ask the question, okay, I invested whenever market PE was below 14 and I held on for 3 years, Sensex, what would have been my return? 91%, 61%, 77%. 2001 October, we all know September 11 attack took place, Ketan Parikh scam, IT meltdown, all of us were licking our wounds in Global Tele, Himachal Futuristic, all those stories. Had you invested in Sensex that time and held on for 3 years, your return would have been 91%. On the other hand, what was wrong with India in 2007? Corporate earnings growth in 2007, record high. So here the objective is, you can earn 91 if you are entering in 2001, then there is blood on streets. But you had a right point. If 15% is what you are going to earn, if you are a passive investor over a long period of time, market sometimes gives you an opportunity to earn much more than 15 if you wait for that kind of opportunity. If you say, I am not going to invest in 20 years at 10 PE, 15 PE and as well as 23 PE, I am going to get in only when the PE is low, and I am going to get out as soon as the PE is going to get expensive, your return will be much more than 15% per annum for the time that you invested. Rest of the time you have to remain cash. Okay. When did the market PE went above 18 last time? 2006, when market crossed 14,900, PE was higher than 18. Okay? So you sold. Next 3 months, index is 16,000. You are waiting, you still have money in SB account, right? After another 1 month, market is 17,000. By then, we are not measuring Sensex, we are getting into mid caps. I can come with some list of 100 names which doubled between June and September of 2007. 3 months. 100 different stocks doubled in value in 3 months. So during that time, is it emotionally possible to remain cash? So what we do is we book our gain and reinvest in something which also would have gone up. So we sometimes lose back the profit. That's where the temperament comes in. But the debate here is, contrarian investing is tougher to practice without understanding basic intelligence, basic understanding of the businesses. That's all I'm trying to highlight. I told our investors, I have a brochure, you can even go to our website. I said, okay, here is a product, okay, April 2013, you go and launch and tell investors, you put money, tenor of the fund is 3 years or 100% return, whichever is earlier. So, if you put money and if it moves 100%, no questions asked, no discretion to the fund manager. I can't show my intelligence to you saying that, sir, wait for another 1 month, 100 will become 130. No. If the needle crosses 100, fund will be closed, all stocks are sold, money is returned back to the investor, you do whatever you want outside that. And I am telling those investors, no brokerage, no entry load, no exit load, no management fee, minimum return 40%, hurdle. Any return higher than 40, 1/3 is mine. Okay? That's it. But the reason I am highlighting that is only one point, that if is a big if, sometimes the fund manager cannot control his own urge. But if I go and tell the investor as he puts money, saying that, boss, as soon as this 23% hits, after that census going to 40,000, 50,000, we don't care. As soon as you reach that 23, just get up. And Warren Buffett used to say that if you are a pilot, how you might have 10 years experience, 20 years experience. You might have been flying all sorts of aircrafts, but today at the age of 52, after 10,000 hours of flying, when you go and sit in the cockpit, the first thing you should do is to take the checklist. You should tick whether this is on, whether this is on, whether this is off. It doesn't mean that the pilot doesn't know whether to check or not. Why are you doing? The reason is it makes you to undergo by a process. And if you don't have a checklist, even if you know that low P is good, this is good, these statistics, if you put it in a checklist and you also see whether there is a market premium, you may like the company, you may like the price, but you may not like the market. I'm going to market with a product where I'm saying I'm going to earn 23-24%. I'm greedy. The reason I'm greedy is I find 95% of the people are fearful. And 2010, why am I like a kid? I was returning money back to the investors, telling them that I don't know how to manage. I earned 67 and I don't think I can sustain this. We return the capital. Why do you do that? The reason is you run out of ideas, and you know everybody has become greedy. And that's the time you should fear. Our fear then was we may not be able to earn even what SB rate is earning. It's better to return the capital. The only way I can relate the same thing is why bull markets are born in pessimism. When pessimism is all around, it also gets reflected in the prices of the stocks, which is where the bull market starts. What is bull market? Starting from the bottom. So, but it is always not V-shaped. We don't know. We know that we are in pessimism stage, and we all know that bull markets begin in pessimism. But the period of pessimism and period of skepticism can sometimes run years, and it has already run maybe a year or 2 or 3, and it may run another 1 or 2 years. As long as you don't leverage, as long as you are investing your own money, part of your own money, the money that you don't need the next 2-3 years, and you don't have an urge to impress your neighbors and friends, and you have to earn that profit every month. When you say that 23% per annum we earn, which is 100% in 3 years, we may not earn any return in 23 months. And between 24th and 26th month, we may earn that 100%. So as long as you have the conviction on the story that you have, and constantly work in building that story, and constantly look out for pitfalls, things that can go wrong, I doubt whether there are any other result other than success that you will face as an investor. Thank you very much for this.